Okay, here we go. Hi there, everybody. I'm Miranda Alt with Keller Williams Success Realty and the Miranda Alt team, bringing you your Wisdom Wednesday. Today, we are interviewing Eric Schroeder again with Mortgage Capital Group. Thanks for being here, Eric.
Thanks for having me.
So today we're going to talk about the 2-to-1 buy down because, of course, everyone is freaking out about interest rates going up rapidly. And Eric, you and I talk about this all the time. We think they're probably going to go up again before the end of the year, right?
Right.
Okay.
Right.
So as they continue to go up, people are going to continue to freak out. And the mortgage industry's response to this has been this 2-to-1 buy down thing. I get texts from it from other lenders that are saying, hey, we've got the solution. Yes, interest rates are going up, but we have this great idea. We have this 2-to-1 buy down, but people don't really understand what it is. So you sent me an awesome document that kind of explains what it is. And I'm going to share that right now with everybody so they can see what exactly this 2-to-1 buy down is. Okay. So, and I love this graphic that you made, Eric, because it just makes it so much more explainable, so much more easy to understand. So you're calling it the 2-to-1 buy down, old school in a new market. So tell me why you call it old school.
Old school. We did this back in 2003. We've been around for a while now and 20 years doing this. And it's just funny how these programs come back. So we're seeing interest rates that are the highest they've been in 26 years, something like that. We expect them to come down next year a little bit. But as we get through it, this has been a very popular thing that a lot of people have been talking about. So we just need some clarity on it, and it's easy. So you just say it like it is. It is a 2-1-0 buy down. So 2% lower interest rate the first year, 1% lower the second year, and then 0 for the third year going forward. So and what you do is you just take a terrible interest rate that you've got if you feel like you're in an environment where the rates aren't very good, and you can have the seller give credits to buy the rate. So in my example, you've got 7.5%. Let's say you're stuck with that. The seller can pay to have your rate as the buyer be 5.5% the first year, 6.5% the second year, and then 7.5% going forward. So there's just a couple different ways to look at an old idea and kind of make it work for everybody as we just get through it, because when you need to buy a house, you need to buy a house. So you can't really worry about the market too much. So what is it?
I have a question for you, because this is something that was not clear to me. And that was that the seller has to pay for this. This is not something that a buyer can be like, oh, I'll do it myself.
Right. The old school way, the banks used to offer it, the buyer could do it themselves. But now, in this new way, the seller has to give the credit.
Okay.
Yeah.
So it's written as a credit at closing on the contract.
Right. Page 1, right there in the contract.
Got it.
And then we figure out how much it costs. So what does it mean? So there's no free lunch in this world. It's all just easy math. So I'll get right to it. If you look at the top right-hand corner of the chart here, it says $300,000 and a 2-1-0 buy down. So that's a 2-1-0 buy down. And then you've got your, if you go to the right there, you take on a $300,000 mortgage for the first year at 5.5%. Look right below it. What you're doing there is you're making the principal and interest payment go from $2,097 to $1,703. So you're saving $394 per month. The seller's giving you the money to do that so that you're enjoying that lower payment.
Now, if I'm a buyer, I'm thinking, oh, great, that's wonderful. I'm going to save $400 a month. That's perfect.
Well, right, at least for the first year. Yeah, so exactly. Now look at the second year. Look at that second column. You've got $300,000 at 6.5%. All that's happening there is that the seller is now going to give you the credit so that your payment goes to $1,896. So again, you aren't paying the 7.5%, which is the $2,097 in the left-hand column there. You are in that gray box in the center, principal and interest, $1,896.20 for the second year. So now you've been 24 months in the home. You spent the first year paying $1,703 when you should have been paying $2,097 in principal and interest. You've got the second year where you paid $1,896 when really you should have been paying $2,097. And then you get into the third year, and in the beginning of the third year, then you've got $2,097. That'll be your new payment going forward. So we've got in there how much in red, that you're saving per month. It's nice to see that. Take a look at the cost to seller, which is that gray the white bar right below. So left-hand column says cost to seller. If you look under the 300,000 at 5.5, the $394 difference per month in payment is what the seller pays. They're just going to give that to you in a lump sum. I did the math there, $394.27 times 12 months, they literally give you 4731
And this
in a
is all,
closing cost credit.
and this is all figured on a $300,000 mortgage.
Yeah,
Okay.
all 300,000. Yeah, exactly. You got 7 and 8, you know, then you go to the next, just to the right there, the $201 savings per month is 201.44 times 12 months, 2417 is the saving, you know, is the savings per year. It's a cost to the seller on that first page of your contract. So take a look at the third column. I added it together, 4731 plus 2417 plus 0 savings for the third year. The seller's going to pay $7,148 in points essentially on the first page of the real estate contract.
So what's going to happen is you're going to write the offer. If I'm the buyer, I'm going to write the offer with the purchase price, and then I'm going to ask for this credit of $7,148, correct?
That's it. And then that money goes,
work out.
Right. The bank is going to know what to do with that. They're going to set your first payment, 1703 the first year, 1896 the second year, 2097. That's all principal and interest. That isn't tax and insurance in this example, but just to make it. The third bar there, the gray after-tax income, the one way to think about this, which I think is, everybody talks about the 210 buy down, you kind of understand what it is. If you have to look at it again, just take a look and study. But let's take it one step further. The reason this is a great concept is because if you figure that you're a household that makes $120,000 a year. Now, I know not every household does that, but if you have a $300,000 mortgage, that's probably about where you are.
Right.
Also puts you above where Social Security, things like that, come into effect, SUDA. If you get a 3% raise at work and you make $120,000 as a household, I've shown the math there. When you look at the first year and the second year, as you look at your income going up 103% or a 3% raise at work. In the first year, under that 300,000, 5.5% year one column, you've got in the first year, as you're enjoying that 1703 payment, your income's going to go from 120,000 as a household to 123,600. You're going to get a $3,600 raise at work. If I take 30% off for taxes that you have to pay for the increased income, your net result as a household, you're making $2,520 more that year. And so that's just more income you've got a chance to make and recuperate and have and earn at work while you're enjoying this 210 buy down. The next year, check that out. You take another 3% raise, you're up $5,115 net income to your household after you've enjoyed the second year of the buy down. So by the time you get to the third year, your income is now $5,115 higher as you begin that third year on your mortgage. The mortgage payment is now $2,097 a month, but you're making $426 more per month as a household based on this example. And what are you saving in that first year? $394. So you kind of get to fast forward and get into a home that's affordable for you 2 years before you've had a chance to earn the money, if that makes sense. And so in theory, you shouldn't even feel the 210 buy down because you're going to have more money come into your home.
And these are all, obviously based on averages and lots of assumptions being made, but they're pretty safe assumptions. And that's what we have to do in our industry to try and predict what's going to happen. Right.
The concept of this program is, hey, we're going to get you into something that maybe you can't, it's kind of uncomfortable for you, but it's going to buy you some time. In fact, it's going to buy you 2 years so that you can get to a place where this home is more affordable when you settle into that final rate there from the third year going forward.
But you and I talked about some problems with this program.
The idea, that you've got, you're really using, the thing that I don't like is if you've got $7,148 that you're getting from a seller, there's some other things to do with it. The nice thing about 210 buy down is if you do end up refinancing, because as I believe, as you do, the rates are going to go down first half of next year, you refinance it to something else. That principal or that money that they gave, the $7,000 actually goes back towards principal. And so that's a good thing. There's some other more creative things we can do. And Miranda, even as you go to sell homes, there's some other ideas you can come up with that can be attractive for buyers coming up. But if we're looking at buyers that are buying, the first thing that's obvious, if you're spending $7,148 to buy down your mortgage for 2 years to make this home more affordable, you could just simply say, listen, I don't want that. And you just take the home for $7,148 less. And my first example there, you're going to save $49.98 because now instead of having a $300,000 mortgage, you'd have a $293,000 mortgage. That's just really easy, $50 a month. Another thing you could do is you can pay off a car, pay off credit cards, you guys, you can pay off your student loans. Is there anything else you could do with these credits from the seller to reduce your closing costs and then go pay off a car with it instead.
Yeah.
That's a great thing to do. You can always drive around a little older car, and then you don't have to worry about, that payment coming back to get you because you paid off the car. And as long as you don't buy a new car, you don't have that $394 payment.
Well, and the interest rates on the car, the credit card, the student loans, those interest rates are sometimes very, very high. And that interest you can't write off on your taxes. So that's a great
Well,
thing
that's
to do.
it. And the federal government's raising, the Fed funds rate, and they're making your life expensive. They're making home equity lines of credit expensive. They're making car loans expensive. And that's the idea, you guys, is this is supposed to be uncomfortable. You're not supposed to be able to afford as much in your household as you once could when rates were super, super low. And so, you have to say, okay, what else do we need to push out of the way so that we can get that fourth bedroom and, we can get into the house that we need to get into, because that's more important than driving a newer car or taking that extra vacation or whatever else it is. That's
right. The whole point that the federal government is trying to do in curbing inflation is make things uncomfortable so people can't spend as much money. That's the whole deal.
Yeah, it requires a little sacrifice perhaps in other areas other than the mortgage. If the mortgage is going to be more expensive,
right,
maybe other things need to go too. And you can use these credits from the seller to pay some of those things off.
Right.
You can also just use the 7148 to pay down the interest rate. It's called buying points. That's tax deductible. You can save yourself 5/8 in rate and save $126 a month just doing that. You can use 2790. I figured out. You can get rid of your mortgage insurance. So if you're somebody that only pays 5% down, you've got fairly good credit, you're going to pay approximately $100 a month in mortgage insurance. You can pay for all of your mortgage insurance upfront and actually have the seller use $2,790 of that money to just get rid of it all right there. That just saves you $95 a month right there. There's all kinds of uses for these credits. You can use the 7148. You want to get, this might be a great idea for if you're listing a home. No payments for 3 months. You can use $7,148, give it to the buyer. Car dealers do this all the time, and say, here, we'll make your first 3 payments for you. It's just built into the price of the car. Same thing here. If you're going to enjoy 7148 from the seller, why not have them give you credits, use that money, and make your first 3 mortgage payments with it?
Right.
All kinds of things to do.
Right.
Yeah.
And this is all assuming, of course, that the seller is going to go along with it in the first place of giving you a credit of 7,100, which if you can do it, but it's a good point that don't just do the 2-to-1 buy down just because it's flashy and it's the new idea that people are coming up with to deal with higher rates. You and I both believe that the interest rates are going to be coming down in 6 months because we trust our good friend Barry Habib, that's what he's saying is going to happen. And so far, so good. He's been pretty accurate. He's not 100% accurate, but he's the one that's come closest to the target. So if we are assuming that interest rates are going to come down, I think this is such a good point that what are some other things that you could do with this money that might make your life a little bit easier long past, because if you're going to refinance, you're only going to have these payments for so long. So, and I like your last idea of using it to buy new appliances or window treatments or flooring or something you need in the house rather than putting it into the 2-to-1 buy.
Maybe it's not the perfect house. Maybe you could save a little and buy a little cheaper house if it isn't completely perfect. And if maybe you can get those countertops you want and you can work on the home when you're in it. All part of our economy tightening and things becoming less affordable and finding creative ways. And so if customers have a problem, I would encourage them to go to your lender with it, go to your realtor with it and say, this is the issue I'm having. And there's all kinds of creative things that could be done financially to make your life more comfortable, get you the home you want.
Right. Absolutely. Eric, thank you so much for explaining this. I know sometimes the math on this stuff gets so complicated, but I love that you put pen to paper and you actually do the math to figure out what is the best solution to get people into the best financial position. Because I the reason that I always refer people to you is because I love how your goal is always to get my clients into the best financial position, not just sell them a house today. That's my goal too. I don't want to be your realtor for today and then you never do business with me again. I want to be your realtor forever. And I know you're the same way with lending. You want to be their go-to financial expert that's going to help them get into a good financial position. So thank you for your expertise.
All right. Thank you. That's why sometimes the news is just tough. Hey, things are tightening and you just have to tighten up. And sometimes it has to be, but we'll just roll with the punches here, and again, bring the problem, and then we'll solve it. Whether it's your realtor or a mortgage nerd, whatever, we'll figure it out.
Right, right. Awesome. Great. Eric, thank you so much. Thank you everybody for watching. Again, Eric Schroeder with Mortgage Capital Group. I'll put his contact information in the comments below. Thank you for watching and have a great rest of your Wednesday. Bye-bye.